Hi everyone, this is Matt Kerfman here with the Richmond Brothers for a late May edition of Matt's Minutes, and I want to focus this session on the word, or I'll say the animal, a bear. In the market, you often hear terms like bull markets, which people like, bear markets, which we definitely don't like. But the mere fact is both of those are part of the investing world. And right now we're playing a little bit more in the bear market territory with both the NASDAQ and the S&P 500. In fact, last Friday, although it didn't close down 20% from its high, midday on Friday last week, it did actually get to a negative 20% number. So we're not technically in a bear market since it didn't close there. But what is a bear market? So first let's define it. All a bear market is, and even a correction, would be when the markets are down 20% from their previous highs. So the S&P 500 was down up to 20% from its previous high. The NASDAQ has already been in that territory. So whether we officially call it a bear market or not, let's just be honest and say the markets have been really challenging this year coming off of those highs. Good news is I want to share some data and some history, and then what are our thoughts at Richmond Brothers relative to individual decisions that you may want or need to make even within and with respect to your own portfolios. So according to, going back in time, according to some Guggenheim research, all the way back to World War II, and we've shared these articles with you just in various newsletters over the last 1 to 2 weeks. But if you break out stock market declines since 1945, a decline of 5 to 10%, there has been over 84 of those since 1945. A decline of 10 to 20%, there has been 29 of those since 1945. A decline of between 20 and 40%, there's been 9 of those such declines. And then if there's ever a 40% plus decline, there's been 3 of those only since 1945. So the lion's share of these declines, once you get into that greater than 10% but less than 20%, 29 of those such declines, the average decline was around 14% during those periods. The average length of the decline lasted was 4 months, so we're just beyond that 4-month window as we're winding down May. And then in that 10 to 20% category, the average time to recover coming out of those dips was actually only another 4 months. So that's certainly on the shorter scale or spectrum of things. But just wanted to give you the historical context. If you go back to the 1950s, according to LPL research, and you look at bear market recoveries, so when the S&P 500 has hit negative 20%, what happens next is, I guess, a question that is on a lot of people's mind, and ours included. And so if you go back to the last 3 bear markets, there was one in 2011, there was one in 2018, and then, of course, there was one in early 2020, periods where the market, the S&P, declined more than 20%. And so the length of recovery once that happened for the last 3 bear markets was 4 months, 4 months, and then 5 months respectively. So if it took, we're already 5-6 months in from the market highs, and then it took another 4 to 6 months to recover, you're really looking at more reasonably about a year. So the question then is, as you look at individual portfolios, what's happening? What should I do about it? Is there anything I can or should do within my portfolio? So first and foremost, we always want to help you manage towards your comfort level and your risk tolerance. Many of you have worked with us on your risk-alike scores, and we kind of want to use that as a language on a scale of 1 to 99. How much risk are you willing to take on and are you comfortable with? The closer you are to 1, the safer and more stable your portfolio is. The higher you are, the closer to 99, the more aggressive your portfolio could be. So as you look at most portfolios now, and you look at kind of a category of safe or fixed or guaranteed, then you look at maybe a fixed income, which we might think of more as bonds or cash flow yielding bonds. And then you look at equities. We kind of look at these 3 buckets. And normally when the equity bucket, which are the stocks, go into a decline or a correction or a bear market, you tend to see a flock to safety. And what's happening a little bit is you are seeing a flock to safety, but for the first time in a long time, we're not seeing that flock into bonds. And the reason why we're not seeing that is the Federal Reserve has started raising those rates, and the price shock has been so dramatic that we're even seeing bonds drop, 5 or 10% in share price. That doesn't mean their yields are dropping. So I want to pause on bonds there and just reference, in the last 10 years, the Federal Reserve interest rate has largely been near zero, which is why a lot of safe money has a hard time earning any yield. Well, the Federal Reserve has widely anticipated, and they've even stated it themselves, they're going to continue to raise that short-term rate. It was at zero. In March, they moved it up to 0.25, then moved it up another half to 0.75. So if you look out over the next 2 or 3 meetings, there could be another 1.5% with a 0.5% increases each meeting on that. So it will eventually trickle to the point where corporate bonds have the ability to be earning 4 to 6%, not 1 to 2%. So if you had 100 grand or 200 grand or 300 grand in bonds, which are going to be generally under risk 25 on that risk score, we've seen some extreme price movement, but really over the coming 6 months, we really should start to see yields improve and more cash flow coming out of those assets. So we think that in that fixed income category, they need a little bit of time to recover from this initial shock of raising interest rates. And then if we can do that, then really the safe assets, which could be cash in the bank, cash in your Fidelity cash reserves, money markets, could be guaranteed fixed annuities. Those are all meant to be very boring. You're not looking for home run returns. That's the one asset class that has largely remained stable through 2022, when we've seen other asset classes temporarily fall from grace, if you will. So one question we have now over in the equity bucket is, do we really think if the S&P 500 and the NASDAQ have now declined at different points by more than 20% and kind of hit that bear market territory, do we really think that corporations and businesses are 20% worse in the last 5 months? And obviously that seems like an interesting question. The answer is probably no. Why is that? We're just seeing kind of the extreme volatility of rising interest rates. The word recession kind of looming around. Well, what happens in a recession is jobs growth slows down, unemployment gets higher, markets become a little more volatile, but I would argue that we're already in that volatile market environment. And so now it's that we're there, what happens next, and do we see companies having the ability to continue to grow out of this? That equity bucket really should be looked at as longer term. And if you have it buffered with fixed income and maybe guarantees, that's going to be a pretty well diversified portfolio. And the question is not about what do I do right now. The question is, can the portfolio sustain and effectively live to fight another day? These things don't last forever. We will get to the other side of it. And on individual meetings and calls and video sessions, we want to help you, especially in retirement, if you're taking cash flow, understand these 3 different buckets and just keep talking through that plan so that we can all live to fight another day financially, so to speak. We're here for you. We're honored to have the opportunity to help educate, inform, and guide you no matter what is going on in the world or in the financial markets. If you have any questions, as always, please feel free to reach out, questions@richmondbrothers.com. And we appreciate having the opportunity to help guide you through all of this. In the meantime, take a deep breath, step outside, enjoy the spring weather if you're able, and make it a great day. Thank you so much for tuning in.